Thank you, Jeff, for that nice intro. My pleasure at lecturing again at Phi is only partly offset by the ungodly hour. I don't think I've had to lecture this early for over half a decade, which, by the way, is why I wasn't there for the optional social hour or social time last night, but I do promise to be there this evening if any of you want to discuss the issues that come up in either of my presentations. The last time I lectured here was at the end of June, the seminar on history and liberty. At that time we had 6 people from San Jose State, 3 on the staff and 3 among the students. This time I count 11 people from San Jose State, either currently at San Jose State or have taken courses from me at San Jose State. To get a sense of how many have actually heard me before, how many were here for the History and Liberty seminar? All right, a few of you. How many have never heard me lecture ever? Okay, good. So I'm not going to be repeating myself to too many of you. How many of you are economists or majoring in economics or doing graduate work in economics? Let's see the hands go up. All right. How many are not economists? Okay, well that sets a task for me. My background is both in history and economics, as Jeff pointed out. I got my PhD in history, but most of my, I've written a book on the Civil War, but most of my teaching has been in economics, and so those of you who've heard me lecture before have heard this quip, which is that I have that interdisciplinary capability that everybody in academia admires and nobody hires. The reason I'm at San Jose State. By the way, I'm not, even though I used PowerPoint last time I lectured, I've decided that the PowerPoint's been overused at this seminar. And so I've refused to do any more PowerPoint stuff. And I hope that you can still follow it without the visual jokes. Why fractional reserve banking is more libertarian than the gold standard. Now, obviously, the title is deliberately provocative because fractional reserve banking and the gold standard are not necessarily mutually exclusive. If I wanted to be a little bit more precise and have less fun, I might have said why fractional reserve banking is at least as libertarian as the gold standard. But the reason I chose this provocative topic is because there is a hostility to fractional reserve banking among many libertarians, a hostility that I believe is totally unmerited. And the term gold standard can mean different things to different people. And some of the meanings of the term gold standard are very unlibertarian. Now, before I proceed, I want to make sure we're all on the same page. So how many people in the audience think they know what fractional reserve banking is? Let's see a show of hands. How many don't know what fractional reserve banking is? All right, well then now let me do another survey. How many of you in the audience think that when you deposit $1,000 in cash at your favorite bank, that the bank continues to hold all of that cash in its vault? Anyone? Well, unless you believe that, you know what fractional reserve banking is. The bank does not hold 100% reserves behind the money you deposit, and therefore it reloans that money, and the result is that banks are private institutions that create money through the process of fractional reserve banking. And in fact, if you look at the United States or most developed countries in the world, you'll discover that most of the money that people hold is privately created by banks rather than being issued by governments, right? Add up the amount of money that you have in your wallets and your purses in the form of Federal Reserve notes and Treasury coins, and then compare that with the amount of money in your checking account, and I would venture to guess that for nearly all of you, the amount in your checking accounts and other bank accounts far exceeds the amount you're holding in the form of cash. In other words, you're holding more privately created money than government created money. Now, in defending fractional reserve banking, I don't want to be misunderstood. Nothing in this lecture should be entailed as a defense of the Federal Reserve or of commercial banking, of central banking. I favor abolishing the Federal Reserve, and I believe that money should be provided on the market. Now, a lot of libertarians have argued for market-provided money, and if you were to survey their positions on what a free market in money would look like, I would argue that they fall into three broad libertarian schools. You can think of these as the three schools of free banking broadly conceived. The first school is the hard money school. The school of Murray Rothbard, Walter Block, possibly Ludwig von Mises. This is a school that argues a free market money would consist of a commodity money such as gold, maybe silver, maybe a combination of the two. But the circulating money that is created by banks would be 100% backed by that gold or silver. That's what the hard money means. It doesn't just mean that you've got a commodity money base. It means 100% reserves. This is the school that's hostile to fractional reserve banking. Then there's another school that also believes that on a free market you would have a commodity money base, but that would be coupled with a fairly sophisticated fractional reserve banking system with really low reserve ratios. How many were here last week for Larry White? All right, that's the position that Larry White takes. That's the position that George Selgin takes, Roger Garrison, Steve Horowitz. So we'll put that down as fractional reserve banking with commodity money. And then the third category is a catch-all category. We can call these exotic alternatives. The easiest to understand system in the third category is Hayek's proposal of envisioning a market, a free market, in which unregulated banks issue private fiat money. All right? In other words, not like banknotes or deposits, money that is redeemable for something else, for gold, silver, but in fact, that banks, the Bank of America would have its own money, Riston would have its own money, Rothbards would compete with Hummels with floating exchange rates between them. This was the position that Hayek first put forward in the denationalization of money. There actually is one historical instance when this kind of system arose, very briefly in the United States during the War of 1812, when the governments allowed banks which were issuing banknotes to suspend specie payments. There was no central bank at the time. Those were private banks, although they were chartered by the states. And so their banknotes essentially became private fiat money, privately issued fiat money with floating exchange rates between them. Other kinds of other types in this exotic catch-all category are other systems, including the Yeager-Greenfield proposal for separating the medium of account from the medium of redemption. There are some who propose separating the medium of exchange from the medium of account. I'm not going to try to explain those. In fact, I don't even try to explain those in my undergraduate money and banking classes. We only get to discussing them at the graduate level in monetary theory, which may give some indication of their likelihood of being adopted and understood by the general public. But if you want to read more about them, or at least some of those more exotic alternatives, I can't recommend too highly Larry White's The Theory of Monetary Institutions, where after defending his own alternative, at the end he talks about some of these others and his objection to them. Now, these three schools, you can think of them as prescriptions about what kind of monetary system we should have. But in fact, if you want to be consistently libertarian, you should think of them as predictions about what a free market monetary system would look like. Because, of course, the market is very ingenious. right, at coming up with unexpected alternatives. So if you have a free market in money, you may have a system that's different than all of these. In fact, this is one of my objections to the heavy emphasis on the gold standard on the part of many libertarians. When libertarians advocate the legalization of drugs, that's recreational drugs, that's not equivalent to advocating the use of drugs. And similarly, I would argue that advocating the freeing up of money so people can legally use gold as money is not the same thing as insisting that people use gold as money. I'll have more to say about that in a bit. So now let's start with a critique of the hard money position. The advocates of hard money, the opponents of fractional reserve banking, have two sets of arguments. They have legal arguments and they have economic arguments. Rothbard and Block make the legal argument that fractional reserve banking is essentially fraud, that when the bank reloans the money that you deposit, the bank is engaged in embezzlement, and when a bank run occurs, the bank gets caught. Now, I don't want to belabor, this, by the way, is the position that Brian was ridiculing last night, and I don't want to belabor the arguments about the legal status of fractional reserve banking. I think it's pretty clear, the fact that most of you in the room know that the bank reloans your money is prima facie evidence that fractional reserve banking is not fraudulent. If you want 100% reserves, you can get them today at a bank, right, with a safety deposit box. Now, of course, it doesn't include the negotiability aspect, but you can get 100% reserves. The argument is based on the notion that somehow a claim to return something on demand is equivalent to a claim to hold it. And yet those claims are not necessarily the same, right? And there's no reason that they have to be the same. Claim to hold something is a bailment. The argument is that fractional reserve banking creates a bailment, and therefore when you reloan the money, you're violating the contract, but you just change the contract. Ultimately, the legal argument against fractional reserve banking is an attack on freedom of contract. And this is clearest when the defenders of this position are confronted with the option clause that existed in Scottish banking until it was made illegal. The option clause, this was a banknote that said the bank will pay to the bearer on demand a certain amount of gold in exchange for the banknote, except at the option of the bank can convert the banknote into a 6-month CD and pay interest to the bearer and not redeem it, all right? Which was, of course, a contractual way of stopping a run on the bank. And, of course, no libertarian who argues that fractional reserve banking is fraudulent could argue that a banknote with an option clause is fraudulent, but you should see them squirm when confronted with that. And it's very easy to figure out contractual ways of getting around this automatic equation of a bailment with a promise to redeem on demand. And there are other situations where, even in money, where you have this kind of arrangement. Banks frequently make what are known as call loans. Loans by banks to brokerage firms, investment banks, which often the investment banks in turn reloan to their customers on the margin. These loans can be redeemed on demand by the banks, and so far I've never heard, that's why they're called call loans, and so far I've never heard of a proponent of fractional reserve banking advocating the abolition of call loans. Now, the economic argument against fractional reserve banking, and this is an argument that Mises may have made. When I read Mises, I thought he was making this argument. Larry White has an article in which he says, I misunderstood Mises, and I haven't gone back and reread it closely enough. But the economic argument is that, well, even if fractional reserve banking is legal, we don't outlaw it as fraud, competition between banks will drive reserve ratios up to 100% or close to 100%. Because banks that have higher reserve ratios will be more easily compete with banks that have lower reserve ratios in terms of customer confidence and the threat of bank runs. Now, the problem with this argument is that it's historically misinformed. It actually is based, you can find a plausible historical sort of antecedent for this argument if you look at the behavior of central banks under the classical gold standard. Because central banks under the classical gold standard, there was a anti-inflationary bias. It was easier to sterilize gold imports than gold exports. But central banks, of course, have exclusive government privileges, are and therefore protected from a lot of market competition. In situations where banks have faced extensive competition and banking systems, fractional reserve banking systems have been fairly stable. The general rule is the more stable the fractional reserve banking system, the more free the fractional reserve banking system, the lower the reserve ratio. Reserve ratios under the Scottish free banking system, which is the freest banking system we know of in the history of the world, were at 2% or lower. In the United States during the free banking era, it's not true that the more stable New England banking systems had higher reserve ratios and the less stable Western banking systems had lower reserve ratios, because the causation worked in the opposite direction. The more stable the banking system, the lower the reserve ratio. And of course, there's an incentive for lowering the reserve ratio. There's a benefit, which is that if a bank maintains 100% reserves, just as with a safety deposit box, you've got to pay the bank to store your gold or silver, right? The bank's not going to do it for free. But if you have fractional reserves and the bank reloans some of those reserves and earns interest on those reserves, and the system is competitive, that interest payment gets paid back to you, the depositor, in the form of not having to pay anything to the bank and sometimes earning some interest, either implicit or explicit. And this leads us to the benefits of fractional reserve banking, the economic benefits of fractional reserve banking. Fractional reserve banking increases the efficiency of the economy. It increases the efficiency of the monetary system. It essentially converts cash balances, idle cash balances, into savings directed through the financial system. And that represents an efficiency gain. And we have other examples of the fractional reserve principle giving us efficiency gains in the economy. How many of you flew in for this seminar? Do the airlines practice 100% reserves behind their airline reservations? No. No? They practice fractional reserves behind their airline reservations. Now, if we had a law that required airlines to practice 100% reserves, what would happen to the price of airline tickets? It would go up in the long run, because the planes would fly less full and it would be more expensive to fly. Some places have parking lots where you get a sticker that allows you to park in this particular parking lot for a month or a year or whatever. Very often those parking lots practice fractional reserves behind their stickers, because they know that not everybody who has a sticker is going to try to park in the parking lot, and that of course represents an efficiency gain, a use of resources more efficiently. Some colleges and universities have cafeterias that you have the right to eat at any meal. Do those cafeterias generally prepare enough food so that they can feed everyone who has a right to eat there at every single meal? Again, an efficiency gain. In fact, you could actually think of the telephone system, especially when we were confined to landlines, as representing a kind of fractional reserve principle, because if everybody tried to call at the same time, right, you'd have a result that was similar to a bank run. Now, of course, the criticism of fractional reserve banking extends to the macro impact, which is obviously if banks create money, other things being equal, the lower the reserve ratio, the higher the money stock. And if the money stock is higher, what can we say about the price level, other things being equal? Let's not hear everybody answer at the same time. Higher, thank you. But this also represents a benefit of fractional reserve banking. Why? Well, because the price level is, by definition, the reciprocal of the purchasing power of money, right? As the price level goes up, the purchasing power of a dollar falls. But if you're under a gold standard or some other commodity standard, the purchasing power of money is the price of gold. As the price level goes up, the price of gold goes down. As the price of gold goes down, guess what? Gold is pulled out of the monetary system and used for production and consumption. And in fact, that partially offsets the increased price level, the gold being drained out of the system. In other words, those of you who've studied economics know that one of the efficiency critiques of a gold standard by neoclassical economists is that it wastes resources, right? A monetary system that uses gold, that has alternative uses, has a high opportunity cost. Any gold that's being used as money can't be used to fill teeth, provide jewelry, or other goods and services. And this argument is completely and totally valid. And it's as valid as the argument that, you know, if we lived in a world of in which bicycle thieves respected paper bicycle locks, right? So that all you have to do is write bicycle lock on your on a piece of paper, scotch tape it to your bicycle would be immune from bicycle theft, and then all of the resources currently used to manufacture bicycle locks could be transferred into something else, and the economy would be wealthier. So the argument that is made often for fiat money is that fiat money replaces gold with paper. Paper is cheaper than gold. Those resources are then used for other things. All right. Good justification, or let's say good is too strong a word. As far as it goes, it is an efficiency argument for fiat money over a commodity standard in theory. Of course, when governments go to fiat money, do they release the gold to the market? Generally, they hang on to the gold, so it isn't always realized in practice. But what we can say about fractional reserve banking is that under a gold standard, fractional reserve banking was the market's way of spontaneously reducing the resource cost of the monetary system and making the economy wealthier. And so the private incentive of banks and depositors to take advantage of fractional reserve banking coincided with a macroeconomic welfare gain. And we can furthermore say that even though the price level is higher under fractional reserve banking, as long as banks are required to redeem their monetary liabilities, whether they're banknotes and deposits in gold, fractional reserve banking never results in sustained inflation. It raises the price level to a new higher equilibrium, and then the price level tends to stay there, other things being equal. Just as credit cards. Credit cards reduce the demand for money. By reducing the demand for money, they raise the price level to a new higher equilibrium than it otherwise would be, but they don't generate sustained inflation. All right, so that's the economic benefit of fractional reserve banking under the gold standard. Are there any questions so far? I know there'll be arguments, but for the moment I'm asking for questions. Yes? I'll get to that at the very end of the lecture, and if I forget, remind me. All right? Let's see, how am I doing for time? All right, the next topic I want to take up. This is all very well under the gold standard, but of course we have fractional reserve banking under a fiat standard. So we have fractional reserve banking saving on the resource cost of a monetary system that in theory has no resource cost to begin with. So what about that case? And in fact, there have been economists like Milton Friedman who have advocated 100% reserves under a fiat standard. In fact, every time there's a monetary crisis like the S&L crisis or the new crisis, this proposal reemerges to impose 100% reserves of fiat money on the banks. And the answer to the question is that even though there may not be a significant, as significant a net welfare gain from fractional reserve banking under fiat money, there is a significant distribution effect. And in fact, this is why government began regulating banking even when there was still a gold standard. And that is, fractional reserve banking represents a serious threat to government seigniorage. How many don't know what the word seigniorage means? Okay, seigniorage is the technical economic term for the direct revenue that government generates from printing money. Right? In other words, if we have simple fiat money, such as during the American Revolution, and the Continental Congress prints up $1 million of bills of credit to finance the revolution, the seigniorage is $1 million. The term seigniorage comes from the government monopoly on the mint. That's very old. When governments began to base the coinage, that generated monopoly profits, seigniorage, and it comes from the French word seigneur, because in feudal France it was the feudal lord who had the monopoly on the mint. Okay, so seigniorage. Now, how does fractional reserve banking diminish government seigniorage or constrain government seigniorage? There are two ways to visualize this. First of all, imagine a $1 billion increase in the money stock in a fiat system in which you have 100% reserves. How much seigniorage does the government get? $1 billion, right? That's the total increase in the money stock. The total increase in the amount of government money. It is the amount of seigniorage in nominal terms. All right? Now imagine a fractional reserve banking system in which for every dollar of government money, there is outstanding $9 of bank-created money, right? So you have a ratio of 10 to 1. Now you have a $1 billion increase in the money stock. How much of that is seigniorage? Only 1/10 of it, $100,000. Or, so one way of visualizing this distribution effect is that the lower the reserve ratio, other things being equal, the less seigniorage the government generates from a given increase in the total money stock. Or another way of saying the same thing is that with 100% reserves, the inflation cost, the amount of inflation that the government will generate from $1 billion increase in the monetary base will be a lot less, in fact 10 times less, than the amount of inflation it would have to generate if the ratio of private money to government money is 10 to 1. Yes?
So if I understand you correctly, then when you have fractional reserve banking, it is inflationary in a way. You are causing inflation in some way through fractional reserve banking.
Well, let's distinguish between inflation and sustained inflation. Fractional reserve banking by itself doesn't generate sustained inflation. But if the reserve ratio remains constant and the ratio at which people want to hold currency versus bank money remains constant, then a given increase in the monetary base by government will be reflected as an increase in the total money stock. In other words, a 10% increase in the base will generate a 10% increase in the total money stock. Since the total money stock is larger than the base, right, that represents a larger increase in the money stock. I'm not sure that was entirely clear. Okay, let me simplify. If you've got a fiat money base and the government is generating inflation, the amount of inflation generated will be increased the lower the reserve ratio, the more fractional reserve banking you have. All right? So fractional reserve banking itself moves you to a new equilibrium at a higher price level. Then you couple that with government increases in monetary policy, and that magnifies the sustained inflation. Got it? All right. Now, this conclusion, right, about how fractional reserve banking reduces seigniorage is very important in the world today. It is the reason that seigniorage has become a trivial source of revenue in all developed countries. Libertarians make a big deal about how increasing the money supply generates revenue for the government. But in fact, in developed countries, the amount of revenue is insignificant. It's still a big deal in undeveloped countries, such as Zimbabwe, which is why Zimbabwe is experiencing hyperinflation. But the reason that developed countries, one of the reasons that developed countries are currently experiencing lower rates of inflation is because seigniorage has practically disappeared as an incentive for governments or central banks to generate inflation. Why? Because of fractional reserve banking. In fact, even during the double-digit inflation in the 1970s in the United States, how many of you are old enough to remember that? A few of you, all right? Where inflation broke 10% twice, the total amount of revenue that pure seigniorage generated for the U.S. government as a percent of total government expenditures never went over 2%. Now, of course, seigniorage is not the only way that government can generate revenue from inflation. There are other ways. Unanticipated inflation, debtors gain and creditors lose, and of course, who's the economy's biggest debtor? The government. And so if the inflation is unanticipated, the government also sees the real value of its debt reduced. And in fact, during the great inflation of the 70s, that was responsible for more than twice as much revenue as the seigniorage. But of course, investors in Treasury securities have become a lot more savvy since the 70s. So that incentive has been diminished as well. Then there's, of course, a third incentive, which is the famous bracket creep, which hasn't totally disappeared, even though Ronald Reagan indexed the tax brackets, because we still have bracket creep with respect to taxes on interest earnings and on capital gains, and, of course, the infamous, evil alternative minimum tax, which is affecting a lot of people. So the amount of seigniorage that the U.S. government is generating today is very, very small. Just to put this in proportion to the total economy, 2% of outlays in the 1970s represented 0.4% of gross domestic product. And on top of that, all right, because seigniorage has become such an unimportant source of government revenue, the European Central Bank and many other central banks in Europe have gone over to paying interest on the reserves that banks hold as deposits at the central bank. And once they start paying interest on the reserves, that part of the monetary base has been converted from money into a government debt, and the seigniorage has been eliminated from that. And Congress has passed a law that allows the Federal Reserve to do the same thing in 2011. So when libertarians, in their critique of fiat money, focus on seigniorage, they are behind the times. And if they want to make their critique of fiat money and central banking current, they're going to need to catch up with reality and offer more sophisticated arguments than the simplistic one that increasing the money stock generates seigniorage.
Is there a type of seigniorage that the United States gets from being the world reserve currency?
Yes, there is a type of seigniorage, but it's fairly minor that the U.S. gets from being the world reserve currency. Currently, the monetary base, 90% of the monetary base is in the form of currency in circulation, Federal Reserve notes and coins, and 50% of that is held abroad. So that means that nearly half of the U.S. government seigniorage, which is less than 1% of total government, comes from not from Americans, but from foreigners holding Federal Reserve notes. All right, now I needed to explain the benefits of fractional reserve banking in order to explain why a simple-minded support for the gold standard can be very dangerous. I'm sure you all know that not all advocates of the gold standard, and in fact maybe not even most advocates of the gold standard, are libertarians. Some of them might be uncharitably described as gold socialists. I think that was a term first used by Dick Timberlake. For instance, last week I was on a panel with Steve Forbes. And he's an advocate of a kind of gold standard where the fractional reserve bank, the Federal Reserve System carries on a policy where it targets the price of gold. Doesn't even hold any gold, just targets the price of gold. Not sure how libertarian that is. Now, even advocates of hard money in the past have been responsible for unlibertarian, very unlibertarian results as a result of their gold fetish. Some of you know about the classic monetary debate that took place in England in the 1830s and in the 1840s. This was a debate about what should happen to the Bank of England and how should the Bank of England conduct monetary policy, or should there be a monetary policy. During the Napoleonic Wars, the Bank of England had gone on a fiat standard to finance that wars. It was returning to a gold standard. And there was many of the economists at the time, and this is something that was discussed in Larry White's first book, were engaged in this debate about how the monetary system should operate with the Bank of England. And there were three schools of thought. This is a slight oversimplification, but whenever you do something like this, it's always a slight oversimplification. The advocates of a hard money, in other words, the Rothbardians of that period, the people who were hostile to fractional reserve banking and advocated 100% reserves, were called the currency school. The advocates of discretionary central bank policy were called the banking school. Now, I don't want to get into a long discussion of their position, but basically the banking school said that the currency school said fractional reserve banking is bad. It creates instability. If we have 100% reserves, that will stabilize the monetary system and we'll get rid of the business cycle. The banking school said, no, fractional reserve banking is good within limits. The money supply should be expanded to fit the needs of trade. Well, how do we figure out what the needs of trade were? Well, we use something called the real bills doctrine, which I'm happy to talk about if people ask me during the question and answer period. But banks aren't always going to adhere to the real bills doctrine unless we've got the central bank encouraging them to do so, the Bank of England. And then the third school was the free banking school. Which looked at what was going on in Scotland. Remember we mentioned free banking in Scotland, which had emerged in 1716 as a result of a bank losing its royal charter one of the least regulated banking systems in history, and they said, no, no, we don't need any banking regulation. We need to get rid of banking regulation. Well, this debate culminated in the passage of Peel's Acts. There are actually two of them, 1844, 1845. And de facto, the currency school won the debate, because what Peel's Acts did was it imposed a 100% marginal reserve requirement on any future issues of Bank of England banknotes, and the Bank of England had a monopoly on banknotes. All right, so it was an attempt to impose 100% reserves through the central bank, admittedly, but still an attempt to impose 100% reserves. What I mean by a marginal requirement is that the currency school didn't want to deflate the currency so that all outstanding banknotes were backed 100%. They thought that would be a little bit excessive, and so they just wanted to make sure that additional banknotes were backed 100% by holding of gold. Now, the problem was that the currency school didn't think that deposits, checking accounts, were money. And so while the currency school won de facto, the banking school won the, actually I said this backward, the currency school won de jure. The banking school won de facto, because there was no restriction placed on Bank of England deposits, which meant that the Bank of England could expand the money supply through deposits rather than through currency. Who was the big loser? The free banking school, because it was the second of Peel's Acts that imposed the Bank of England's monopoly on banknotes on Scotland. In other words, free banking in Scotland was destroyed in the name of the gold standard. The freest, most libertarian, most stable banking system that we know of historically. Other examples, not quite as severe. In the United States, as a result of the evil Alexander Hamilton, the United States got a government mint. This is a period in which gold and silver throughout the world both tended to circulate. When people were free to choose their money. Neither drove the other out of circulation, and the reason is because gold was better for large transactions and silver was better for small transactions. Now, if you have gold and silver circulating side by side as money and a floating exchange rate between them, that's known as a parallel standard. And that works fine. But of course, in a vain effort to reduce transaction costs, very often government would fix the exchange rate between gold and silver, right, in order to simplify transactions, and it would have the same impact as any form of government price fixing, right? If the government fixes the price, it can fix the price at the market or at equilibrium, above equilibrium, or below equilibrium. If it hits equilibrium, then there's no impact, but if it is not at equilibrium, it creates either a shortage or surplus. And the application of these principles of price fixing to money are known as Gresham's law, right? Bad money drives out good. The precise formulation is that when you have government price fixing, the artificially overvalued money is in surplus and drives out of circulation the artificially undervalued money. So when Hamilton set up the mint, the market ratio between silver and gold was about 15.5 to 1. Hamilton set it at 15 to 1 for reasons that are in dispute, but the net result was that in the early part of U.S. history, the U.S. Republic, silver drove gold out of circulation. Now, Hamilton was happy with that result because that encouraged people to use U.S. banknotes, because he also set up a central bank for large transactions. The advocates of hard money in the United States were the Jacksonian Democrats. And they not only destroyed the second bank, the second central bank in U.S. history, but they were so fixated on gold that they decided to change the mint ratio from 15 to 1 to 16 to 1. And so, especially after the gold rush in California, you had a flip operation of Gresham's law, where previously silver had driven gold out of circulation. Gold now drew silver out of circulation. That created more serious economic problems because what were people going to use for small transactions? There were readily available substitutes for large transactions in the form of banknotes, but not for small transactions, especially since many states prohibited issuing banknotes in denominations less than $1, which at that time was a lot of money. And in fact, this resulted in a series of problems. The first response of the U.S. government, by the way, this is a period in which the U.S. Mint was minting full-bodied silver coins, full-bodied gold coins, and copper pennies. And it was competing with private mints that also issued coins. In 1853, in order to create more small denomination coins that would stay in circulation, the U.S. Mint, because of the faulty mint ratio, issued the first subsidiary silver coinage. In other words, coins that had silver in them, but not equal to their monetary value. Now, these were token coins, and they weren't fiat money because they were redeemable for gold at the mint and in general circulation. But it was an initial step in the development of fiat money in the U.S. Eventually, during the Civil War, those subsidiary silver coins disappeared, and therefore the central government during the Civil War, national government, began not only issuing fractional fiat currency, but also special postal stamps that could be used. And indeed, this denominational shortage continued to plague the country after the Civil War, and played a large part in the misguided silver crusades and greenback crusades of the post-Civil War period. The solution that people were advocating was the wrong solution, but there was a severe denominational problem where there was, when people are, you know, if the price level is flexible, you can't have a shortage of money in the aggregate. But you can have denominational shortages. And this is a problem that resulted. Two more examples, then I'll wrap up and open it up to questions and answers. The Great Depression. The Great Depression was worldwide. And there are some economists who argued that one of the things that transmitted the Great Depression from the United States to other countries was the mechanism of the gold standard. Now, we could get into a long debate about this argument and what are the parts that are valid and aren't valid. But clearly, the gold standard under central banks, with its deflationary bias, played some role. I'm not arguing it was the most important factor, but it played some role because when you link the gold standard to central banks, you got some problems. My final example of where you can get problems with the gold standard: European colonialism in Asia and Africa. The dominant motif in this colonialism was that the European powers would go into an area of Africa or Asia and claim sovereignty. And then they'd go to the local villages, see the headman, and say, we're your rulers, you now have to pay head taxes or hut taxes. Not only do you have to pay these taxes, but you have to pay them in the form of European money, which was either gold or paper money backed by gold or silver. How were the now the native economies were using their own primitive commodity monies and doing fine with that. So how were they supposed to get the European money, the gold-backed money, to pay the head or hut taxes? Well, the rulers would point out, well, it just so happens that we have a European-owned farm over here where your men can work and earn the money to pay the taxes, or a European-owned factory over here. It was a way of imposing a tax on leisure, right? A tax that encouraged people to work harder and longer than otherwise, and it was done through the monetary system. And it exposes an important insight often overlooked by libertarians. As long as the state has the power of taxation, it will have an enormous influence on the monetary system. And so you should be very wary of using the term gold standard, because who's imposing that standard? And as long as we have taxation, the most that we can hope for, the best we can hope for, is that government defaults to the money that people would otherwise choose on their own in the market. Now, having said all of this, let me conclude with a final sophisticated argument of my own as to why a system of fiat money with fractional reserve banking is, even though despite all the benefits it gives in terms of reducing seigniorage, is in the long run unstable, and why that might be a good argument for having some kind of commodity base. Most of you are familiar with the argument for money, right? The problem of the double coincidence of wants. It's very often presented as a three-person trading problem where I want to trade with Sheila. She has a valuable CD that I would like, rare, produced by my favorite rock group, which is Oingo Boingo, right? And I've got an endowment of chocolate chip cookies, and I offer to trade my chocolate chip cookies for the CD, but Sheila hates chocolate chip cookies. She wants to have something healthy. And we find out that Brian, or I find out that Brian loves chocolate chip cookies and has a whole bunch of apples, right? So I trade my chocolate chip cookies for Brian's apples. Sheila is happy to trade the apples for the Oingo Boingo CDs. We've got a medium of exchange, and we capture the gains from trade, all right, and solve the problem of the double coincidence of wants, and that's the origin of money. Now, what's often overlooked is that there's another, more elegant solution to this problem, and that is we assume a benevolent bureaucrat God and have him direct me to give Brian the requisite number of chocolate chip cookies, and Brian to give Sheila the requisite number of apples, and Sheila to give me the Oingo Boingo CD, and we capture the gains from trade without having to use the apples as a medium of exchange. Of course, in the real world, the problem with this solution is we do not have a lot of benevolent bureaucrat gods to call upon. But in the modern world, we are developing something almost as good, which is the computer. And in fact, you can think of fractional reserve banking, electronic funds transfers, and a lot of other financial innovations as the world moving from a 100% commodity money system towards a very sophisticated computerized barter system where no commodity is ultimately used as money. Now, the problem with that evolution is that if it occurs under a fiat standard, what it means is that the long-run equilibrium is zero demand for the fiat-based money. And if you have zero demand for the fiat-based money, what's going to be the price level? Infinite. All right? Infinite. This, by the way, those of you who've had monetary theory, this is consistent with the legal restrictions theory of money. On the other hand, if you have a base money that is gold, silver, some combination, or any other commodity, then the long-run equilibrium becomes a system where the price level is anchored, where no gold is ever actually used in any transaction, but it anchors the price level for this sophisticated computerized system of barter. In other words, you achieve the Walrasian nirvana of, that's in economic terms for the economic majors, of where you just arbitrarily pick one good as your numeraire, as your unit of account, and it provides you with a price level, and it's never actually used as money. And indeed, this is the main reason we have observed 3% inflation under Alan Greenspan over the last 20 years. If you look at the monetary base and you adjust for the amount of currency going overseas, Greenspan has essentially frozen the monetary base. But what has happened over this period is that banks have become more efficient at using their reserves, and therefore reserve ratios have been steadily declining, and therefore the equilibrium price level has been slowly rising. So my conclusion, of course, is that libertarians need to rethink their hostility to fractional reserve banking, rethink their alliance with more conservative advocates of the gold standard, and come out more consistently for complete and total monetary freedom. Thank you very much. And I have half an hour for questions and answers. Yes, sir.
Just on your last point, I would object to the figure of like 3% inflation. I'm sure you're probably familiar with the fact that they've changed the way they report inflation since like I think it was sometime in the 1980s where they stopped including certain things. And so, and partly that, and then also the increase in technology. And so, you know, the consumer price inflation may be relatively low, but imagine how much prices would be decreasing if we didn't have, massive infusions into the monetary.
Well, the second part of your argument is correct, right? If the money stock were growing at a slower rate, the price level would be growing at a slower rate. And the Federal Reserve could have engineered a deflation if they had been so inclined in terms of their monetary policy. But I disagree with the first part of your comment. As Brian points out, we don't ever have perfect knowledge, which means we don't ever have perfect macroeconomic aggregates. And, but imperfect numbers are better than no numbers at all. And I would say that there's the evidence that the CPI overstates inflation is greater than the evidence that the CPI understates inflation. If you look at the details. Now, I will concede that I don't ever look at the core rate of inflation. I think that is a smoke and mirrors job by the government. But the aggregate CPI, I think, is the best estimate we have of inflation for the U.S. And well, not the best estimate. It's a good estimate. Another good estimate is the GDP deflator. The GDP deflator hasn't been that far from the CPI. So we have two different ways of arriving at the estimate of inflation. I think it's a fairly good estimate. And my guess, although I can't be absolutely certain, is that it overstates rather than understates the amount of inflation that we've experienced.
Wouldn't you say they have an incentive, though, if anything, to understate it?
Yes, but but I don't think it's a, they do have an incentive, which is why they created the core CPI. But I don't, but you know, in this case, you need to go beyond theory and actually look at the evidence. And the evidence is not strong that the CPI understates inflation. Yes?
Currently, the money we use has no intrinsic value, only the idea that it can be exchanged for wealth. Were we to
I can't hear you.
sorry, our current money that we use has no intrinsic wealth, only the idea that it can be, or no intrinsic value, only the idea that it can be exchanged for wealth. Were we to scrap the current system and move to a truly free banking system, how would you, I guess, go through the process of exchanging money we currently have for whatever currency we use for the free system?
There are two things I want to say in response to your question. First of all, I object to the term intrinsic value. It's true that current money has no intrinsic value, but neither does gold. In this respect, I do agree with Ed Stringham's presentation. Gold only has subjective value, right? Okay, now there is a difference between fiat money and commodity money, but it doesn't have to do with the intrinsic value. It has to do with the relationship between the monetary value and the commodity value of the money. With commodity money, there's a close relationship between the monetary value and the commodity value. With fiat money, their monetary value far exceeds the commodity value. The second part, how do we make the transition to a free system? That's a tough question, and I don't have a pat answer for that yet. One way of doing it is trying to privatize the Federal Reserve. The Federal Reserve is currently holding title. Actually, the Treasury holds the gold, but the Federal Reserve is holding title to a lot of gold. On the balance sheet of the Federal Reserve, it's valued at historical values, which means it would be worth a lot more if it was marked up to market value. So you could, at some point, make Federal Reserve notes redeemable for gold, and then eliminate all the advantages that the Federal Reserve has in terms of regulation, and just make it one bank among many. That's a possible solution, but I could give you difficulties with it, and I haven't seen any really. I mean, making the transition from a free society, from a status society to a free society, is often a difficult problem, which I think libertarians have not spent sufficient time exploring. Chuck. You got to speak up.
Did you hear Ben Powell speak from Somalia last night?
Mm-hmm.
How do you respond? Ben Powell noted that the money in Somalia was foreign paper and was printed on.
Right.
Do you think that refutes your notion that fiat money has zero value or price level associated? Because he's basically saying that there is an anchor, because the fiat money has an anchor in the price of paper printed on.
Interesting. Interesting claim. Yeah. So can we imagine a world in which Federal Reserve notes well, this raises some complicated issues because I made the distinction between the monetary value and the commodity value, but there are actually two commodity values. There is the cost of producing it as money, and then its commodity value in alternative uses, and those aren't always the same. And Ben is talking about a system where I believe he's talking about a system. I've read some of the articles on this, by the way, but I believe he's talking about a system where the value of the currency has fallen to the cost of producing it. But obviously, the currency doesn't have an alternative use that's equal to that. So maybe that, but I guess I'm getting distracted by a side issue that's intriguing to me. But the bottom line is that a lot of the base money is in the form of reserves rather than currency, and reserves are just often, account balances on a computer. And I can't imagine how that process would operate the way the Somalia process. But Brian's going to enlighten us.
The key to Ben's whole example is that the Somalis couldn't accept any new higher denominations of currency. So as long as we just keep adding up zeros, what you said is true. If for some reason the public has 1,000, as we know it should never be, then there actually is no
What Brian said was the key to the Somalia system was the denominational preference of the Somalis in terms of not allowing people to add zeros to the currency. Yes?
Seeing that the penny is worth less than the copper it's printed on, is there any scheme that we can come up with to collect pennies and cash in by selling them for their raw value?
Yeah, you can do that. It's illegal, but you can do that. Actually, it's not copper anymore, it's zinc. And the zinc, there have been arguments for getting rid of the penny for both in terms of the fact that it generates negative seigniorage for the monetary system, in this case the Treasury rather than the Federal Reserve, and secondly, it would streamline accounting. But the zinc lobby, there was a great article on this in a issue about 3 or 4 months back in the New Yorker. The zinc lobby has been very successful at blocking all efforts to get rid of the penny. It's now illegal for you to do this, to convert it to commodity, but you could probably do it on the side in the black market, and if the price disparity goes up enough, people will start doing it. And it turns out that the major economist who's been defending the continued use of the penny because of the alleged rounding tax that would result from the abolition of the penny was exposed by the New Yorker as being hired by the zinc lobby to make the argument. So I would recommend going to the website for the New Yorker and checking out that article if you want more details on this whole issue. It really was an excellent article, and he knew a lot about the detailed history of the penny and the restrictions and all of that, and some of the details I've forgotten since reading the article. You had a question. You've been waiting for a while.
I guess just firstly, with respect to Milton Friedman, I think his leaders here quite a bit from advocating for gold standards because of the question I'm about to ask.
Well, excuse me. First of all, let me finish coughing. And secondly, you need to speak louder.
Anyways, the question I want to ask is simply, currently with M1, M2, M3, or the money being so very difficult to track and monitor, many have suggested, argued that it's absolutely impossible to even have a gold standard. And so the idea of advocating for one is simply, I guess I would say, is a bad option because it's impossible.
Okay, it seems to me that you're combining two arguments that were separate arguments, all right? It is true that beginning with financial deregulation in the 1980s, all of the broader monetary aggregates began misbehaving. Now, I'm not clear as to why that creates a stronger argument than you had before against or in favor of a gold standard. But the behavior of the monetary aggregates is an interesting issue that is, or misbehavior of the monetary aggregates has been an interesting issue that has intrigued me. What I find stunning about that is that it used to be that Austrians and monetarists would say that you should judge monetary policy by looking at the money supply, at some measure of the money. And it was the Keynesians who said, no, you judge monetary policy by looking at interest rates. With the misbehavior of the monetary measures, everybody's become a Keynesian, including libertarians like Ron Paul, who want to judge Federal Reserve policy by looking at the federal funds target, the interest rate. Interest rates have never been a good way of judging monetary policy. They were not a good way of judging monetary policy during the Great Depression. They were not a good way of judging monetary policy during the great inflation of the 70s. And they are not a good way of judging monetary policy, especially today, where we have an increasingly globalized economy and interest rates are globally determined by the market, which is not to deny that central banks are noise traders in the interest rate market. But their ability to influence interest rates is, if anything, declined over the last 20 years, not increased. And so I am I've been one of the lone voices in favor of the old-fashioned judging monetary policy by looking at the monetary measures. The broader monetary measures are misleading because they're deregulated, which means they become controlled by the market. Everything that M2 adds to M1 no longer has any reserve requirements behind it. And many checking accounts have been classified as M2 rather than M1. So only M1 has reserve requirements behind it. That means M2 and M3 are market-generated measures. They'll tell you no more about what's happening to monetary policy than if you took M2 and added the supply of toothpicks to it. What do you look at? You look at the monetary base. That's what the Federal Reserve controls. And the reason that looking at the monetary base has not been picked up by economists is because of the huge amount of currency going overseas, and the figures are not adjusted for that. So I answered a slightly different question than you asked, but I hope you found it interesting. You had a question, ma'am.
I was wondering, had any influence about transitioning to Sacagaweas or coin dollars instead of regular dollars?
The question was about Sacagaweas or coin dollars. The problem is that there is this network effect in money where it's really convenient to use as money what other people are using, and that creates a difficulty in terms of you deciding to switch the money that you're using when nobody else you trade with does. Julia.
Let's say that we're like 100 years from having a computerized market system and 50 years from having complete free banking. What do you think the market would choose? Would we have commodities, standard, or competing fiat money, or possibly?
I guess I agree with Larry White. I think my prediction is that if somehow we could create a market that was not too heavily biased by government, it would gravitate towards some commodity-based money with fractional reserve banking. But it may not be gold. You know, it might be. I can just as easily visualize an alloy of gold and silver. That doesn't seem to me. A basket of commodities seems to me to be an overly cumbersome system. And you'd want the price level anchor, the medium of account, to be something that people could easily understand. 2 metals or 3 metals in some combination doesn't seem to me to tax the general public very much. So the market, in an effort, because it might create greater stability over the long run, might move towards that. And the evidence, I mean, this is not exactly a parallel case, but the fact that to the extent that in medieval Europe, that when money was, internationally unregulated, even though there were a lot of regulations at the local level, the market went to gold in large transactions and silver in small transactions. Yes, sir. Why does there need to be a commodity base at all? Well, it doesn't necessarily have to be a commodity base, but it has to be, you have to have, if you're going to have a price level, right, An average I mean, okay, let me back up. A price is a ratio, right? That's clearest when you think about a barter economy. Oingo Boingo CDs for chocolate chip cookies, right? 20 chocolate chip cookies. If the price of a CD is 20 chocolate chip cookies, what's the price of a chocolate chip cookie in that transaction? 1/20th of a CD, all right? So prices are ratios. And this continues to be true when you have a monetary system. Now, sometimes people mistake this. They say, well, that when money becomes a unit of, or provides a unit of account, it's the common denominator in all transactions. Well, actually, it's the common numerator in all transactions, right? Dollars per CD, dollars per chocolate chip cookie, dollars per rubies. That's why the French use the word numeraire for this function of money. Now, in order to calculate a price level, right, you're calculating the average price in terms of the numeraire, right? So you've got to have one good that operates as your numeraire. If it's a good that nobody wants, it's a good that doesn't have a price. If it doesn't have a price, neither does anything else in relationship to it. And therefore, you don't have a price level. You don't have a unit of account. That's why. Yes?
You didn't speak very much on bank runs, so I was wondering, like, what you feel like, libertarian society, what would there be? I mean, obviously, you touched on contracts and there being, like an escape route for the bank runs, but it seems like that's, as far as like what Rothbard, said about, free banking, it seems like one of his biggest qualms with
Right.
it was,
Right.
The default on their promises.
Right.
And also, if you could comment just on, in Rothbard's, his government, not our money, he talked about the history of,
Which, by the way, I assign in all my money and banking classes.
the history of like the warehousing. Do you think that, I mean, obviously I can see the evolution to today. It doesn't quite seem like warehousing, but in the beginning, when the goldsmith would take people's gold, if you could just comment on.
Okay, well, let me answer the first question. I mean, one of the arguments for 100% reserves is that it eliminates bank runs, right? And that's a valid argument. So the question is, what causes bank runs? And among those who are more favorably inclined towards fractional reserve banking, there are essentially two theories of bank runs: the government failure theory and the market failure theory of bank runs. And if you have a market failure theory of the bank runs, or even maybe it wouldn't be fair to call it a market failure theory under Rothbard's terminology, but that's essentially what it is, then that creates an argument for some kind of government regulation or a total restriction on fractional reserve banking altogether, which is the extreme form of government regulation. I tend to agree with, or I don't tend to, I strongly agree with Larry White and George Selgin that bank runs tend to be government failures, and that they tend to have resulted from too much regulation rather than too little regulation, that they resulted from legal restrictions, and that the fewer legal restrictions you have on banking, the less likely you are to have a bank run. Now, well, actually I should say, I should have at the outset of this distinguished between a bank run and a bank panic, okay? A run on a single bank is not necessarily a problem, all right? It's one way that the market can discipline poorly managed banks. So we don't necessarily want to eliminate bank runs. The argument is that if a run on one bank leads to a run on the entire system and you have a contagion, or now the fashionable term is systemic, however you pronounce it, risk, that creates a macroeconomic problem. And the argument of White and Selgin is that the contagion effect is produced by various government regulations and legal restrictions. And their historical evidence is the fact that you have fewer bank runs, bank panics, the less regulated the system is. And in the U.S. system, which tended to be particularly prone to bank panics, it's also unique in the history of developed countries in having one of the most fragmented banking systems. Again, another result of the Jacksonian hard money movement, which in their free banking laws imposed the system of unit banking on the country, so that you, for a long time, you had a banking system where not only was there no interstate branch banking, but there was no intrastate branch banking as well. Now, that's not the only legal restriction that I think contributes to the problem, but it certainly is an important one in the history of the United States. We still have time for more questions. I shouldn't have finished so early. Chuck.
How would a commodity gold, right, how would a commodity standard under 100% reserve and a commodity standard with fractional reserve behave differently with respect to the seasonal variation in the demand for money? So how would that affect the price?
The question is, how would a commodity system with 100% reserves versus a commodity system with fractional reserves behave differently with respect to changes in the seasonal demand for money? And the answer is that with 100% reserves, the money stock can't vary at all, and therefore all of the changes in the seasonal demand have to be captured in either price level movements or in price level fluctuations or in interest rate fluctuations or some combination of the two, whereas with fractional reserves, with banks able to respond to changes in the demand for money, they can change the supply of money in response to the demand for money, and therefore you get fewer. The more that you have a money supply response, the less you're going to have a price level or interest rate response. And Brian wants to add to that. Oh, totally different question. Okay. Did you want to follow up?
Well, yeah. I mean, it seems to me that's another argument for why fractional reserve banking is better than 100% reserve.
Yes, I agree. Brian.
Jack, agree or disagree? If you look at all government enterprises in advanced countries over the last 10 years, central banks are actually the best or almost the best run. Consider the whole universe, all the post office, roads, on and on, no central banks in there. The difference between
Agree.
central banks give us
Agree. All right. Central banks are the best run, right?
so if you want to
Okay. Well, my explanation for that is that central banks is the autonomy of central banks, or the independence of central banks. In other words, the term central bank can be defined either very narrowly or very broadly. And the broad definition of a central bank, the one that I like to use, is any bank that has some exclusive government privilege not enjoyed by any other bank. Under this broad definition, the Bank of England, when it's first established, is a central bank. The first Bank of the U.S. is a central bank, even though neither of those banks enjoyed the two most common privileges that central banks gained historically. The first was a monopoly on the issue of banknotes, which prior to modern technology were far more liquid than deposits. And the second was a permanent suspension of specie payments for banknotes, whereupon their banknotes became fiat money. So you got this spectrum, and at one end of the spectrum, you've got the Bank of England when it was first founded, the first Bank of the U.S. You've got a private institution with some government privileges. At the other extreme, a central bank that is completely and totally under the thumb of its treasury, such as the Bank of England before current reforms, right? You've got a government institution. Where the transition occurs is one of those hard dividing lines, but all central banks are currently government institutions, but they vary in the amount of independence they enjoy, and the evidence is pretty strong that the greater the independence, the better the monetary policy they conduct. So those monetary cranks who complain about the fact that the Federal Reserve is privately owned, they're mistaken, but I wish it were because we get a better policy from the Federal Reserve the more you put private incentives. Or another way of putting it is that you know, the Supreme Court is still part of the U.S. government, right? But the fact that it is independent of the executive means that the decisions you're going to get from the Supreme Court as it's currently constituted are different than if the Supreme Court was filled with judges that served at President Bush's discretion, right? And that's the same with respect to central banks. So that would be my explanation, which I think you would agree with.
I'm just curious to get your opinion on Walter Block, who's been before. I think Walter Block would be much angrier with you now that he hears this additional narrative.
Oh, really? Yeah. Well, I love making Walter angry. Yes, ma'am.
This is kind of an odd question, but at one point I was listening to a lecture on ways of not playing currencies or other currencies other countries have used besides gold. And one that was brought up was in England, something called like notch sticks or something, where the king required payment of taxes and these sticks that had certain amounts of notches on it. Have you heard anything like this? Or,
I've heard of things like this, but that particular example I don't know about.
okay.
By the way, well, is there one final question? Because I have something else I wanted to close with. We got two people asking questions. Is there anyone other than Chuck, and what's your name?
Steve.
Anyone other than Chuck or Stephen who has a question? Yes, in the back of the room.
I wonder if you have a theory or an explanation for why free banking arose in Scotland, of all places on earth. Why would it have been in Scotland?
Well, it's not surprising that it arose within the orbit of British influence, because that's where a lot of free institutions that we're familiar with today originated. But why in particular it was Scotland, I don't know enough Scottish history to be able to answer that, and the answer may just be serendipity. Okay, Chuck, one.
How would it find out how many people in the audience paid for a fractional reserve back payment?
Oh, I don't like doing that. But since you asked, all right, how many of you are hard money advocates, 100% reserves? Raise your hands. Don't be shy. One. No, you're not. You want to come. You keep changing your monetary preference. All right, and how many prefer fractional reserve banking? And how many are still undecided? Let the market decide. All right. I want to conclude with one last point that I was going to stick into the talk somewhere and then I forgot about it, which is the third alternative in the free banking school, the Hayekian the Hayekian version of that alternative, competing fiat currencies. And this actually relates to Brian's question. Another reason that central bank policy is not as bad as the policies of other government institutions is because of globalization. Essentially, what has happened is we've achieved a sort of bastardized version of Hayek's world. We now have competing central banks issuing fiat money, the elimination of almost all exchange controls and currency controls so that you can go and move to whatever currency you want to as an alternative, right? You can switch from holding dollars to holding euros or yen. And the result is that central banks today face a much larger amount of market discipline than they have ever faced in the past. If a central bank does begin engaging in a Zimbabwe-type monetary policy, that becomes immediately priced on the market, on the foreign exchange markets, in terms of the inflation premium on interest rates, and the central bank is effectively disciplined. And the clearest illustration of this is all of the recent episodes over the last 20 years where central banks and speculators have gone up against each other, right? Central banks not only are noise traders in the interest rate market, they also are the biggest institutions trying to misprice their currencies. But if they significantly try to misprice their currencies and speculators decide that the currency is mispriced, right? So they go to battle against each other. Who always wins and who always loses? Speculators always win and the central banks always lose. And they've learned that lesson. So thank you very much.